Hello students, welcome to SGC online classes. Today we are going to start a new chapter on generally accepted accounting principle for class 10. In short, it is called GAAP. Here in this chapter, we'll understand the primary objective of financial accounting and its reporting. What is GAAP? What is generally accepted accounting principles? Let's start with that concept. Basically, in the accounting world, every accountant, if they maintain their accounts in their own way, then there will be no uniformity. There will be no uniformity, there will be no similarity, and they will make on their own, which will not be acceptable as per the accounting standard. Therefore, it is made a common accounting principle which will be accepted and which has to be adopted by all the accountants across world. It's not only in India. Now, question is, what is called GAAP? It's a term that applies to the broad concept or guidelines and detailed practices in accounting, including all the conventions, rules, and procedures that make up accepted accounting practice at a given time. It's a common accounting principles which everyone has to follow. What are those principles? What are those guidelines? That we'll come to know in the later stage of the chapter. So, in short, we can say that this is the common accounting principles which has to be accepted by all the accountants or who are in the accounting profession to follow those principles, to follow those rules, to follow those guidelines. There are some definitions of GAAP. Accounting principles are the rules of action or the methods and procedures of accounting commonly adopted while recording business transactions. As I mentioned right now, it is a common procedures, common rules and methods. Whoever maintains their accounts, they have to follow these guidelines. If we make a differentiation of accounting principle, there are two concepts are there. There are two things are there involved in accounting principle. One is accounting concept and one is accounting convention. What is accounting concept? These are basic assumptions and fundamental propositions concerning the economic, political, and sociological environment in which accounting must operate. This is the accounting concept. Suppose the guidelines, the rules will be same, but as per the political and sociological environment, it varies. In India, the accounting year is not a calendar year. Accounting year means the period for which we are maintaining our accounts. That is called accounting year. That is maintained as April to March. But if you see in European countries and some other countries as well overseas, they maintain the accounting year from January to December, because it suits as per their environment, as per their concept. But the policies, the guidelines, the concepts will be same. Accounting conventions are tradition and customs which guide the accountant while preparing the accounting statements. It is a guidelines, the customs by which the accounts can be maintained. The accountant cannot maintain their accounts as per their own will. They have to follow certain guidelines. When we are talking about the accounting concept, there are two concepts. One concept is there that is called double entry concept. What is that double entry concept? Every transaction, we know in accounts, whenever money involves, that amounts to a transaction. Please keep it in your mind. If any transaction happens where there is no monetary engagements are there, that is not a transaction in accounting terms. In accounting terms, every transaction should involve money. They have two aspects: receiving of a benefit and giving of the benefit. In double entry concept, there are two sides are there. I think you have already know this fact in class 9. There are two sides are there. One is debit and one is credit. So every transaction will have two effects. One will go to debit side and other one will go to credit side. This is called double entry concept. What is called accounting period? As I mentioned earlier, the accounting period is the period for which we are maintaining our accounts. In India, the accounting period is April to March, but in overseas, if you see, they maintain January to December. That they can maintain. But the guidelines will be same. Accounting period is a span of time for which you are maintaining your accounts, at the end of which financial statements are prepared. The whole year you are maintaining accounts. At the end of the year, or presently because of the software, you can maintain your accounts, you can make your financial statements in the mid of the year also. You have to maintain the financial statements, which will reflect the entire financial position of a company. Cost concept. Assets and liabilities should be recorded at a historical cost. That is cost of as an acquisition. Now, question is, when we are talking about the entry of transaction, what should be our guideline? When we are purchasing an asset, suppose machinery, furniture, building, whatever it is, it should be recorded at a historical cost. Historical cost means the cost which we have incurred at the time of acquisition, when we purchase that assets. Same thing applies for the liability also. When the liability occurs, it should be recorded in the historical cost. That means at the beginning, how much was your liability? Realization concept. The revenue principle, realization means the realization of revenue. Whenever you are doing business, you are incurring the expenses. Expenses in terms of operational expenses to run the business, expenses in terms of to buy some assets. But from this business, the purpose is to earn revenue. When we are earning revenue, that revenue principle governs two things. Number one is when to record the revenue and the amount of revenue to record. That is a very, very important thing which will be discussed a little bit later. When we are talking about the revenue, when to record the revenue and how much revenue we need to record. To be recognized, revenue must be earned. Goods are delivered or a service is performed. When a goods are delivered actually or a service is performed, that is called a revenue is earned. And realized means a cash or a claim of cash is received in exchange of goods and services. When you are delivering a goods, That means you have earned revenue. You have earned revenue, that doesn't mean that you have realized the revenue. When you receive the cash or a claim to cash, which is called credit, that is called actual realization of revenue. The matching principle is equal to what? It's a very simple concept. The entire revenue of the organization from the business, whatever revenue you are earning, you have to deduct the expenses, all the expenses. Then the net income will come. What is called accrual concept? The incomes and expenses should be recognized as and when they are earned and incurred, irrespective of whether the money is received or paid for it. Accrual concept means any income or expenses should be recognized when they are earned or incurred. If you have not paid for that expenses, if you have not received the money, then also it will be entered as per the accrual concept. That means money has been accrued but not paid. Money has been accrued but not received. Same thing here, convention of full disclosure. In accounts, we need to disclose every fact honestly. We cannot hide.